Hello everyone. Thank you for joining in for today's YouTube video. I'm going to explain one simple and one very interesting understanding about India VIX and its role in premiums, or how you should ideally consider whether to buy an option or sell an option. Okay, this is just a basic, again, a crisp understanding of the concept of India VIX and application of that, or positioning yourselves in such a market. Today, as we all know, the market has been crashing down. So, in a way, again, continuing on to the previous shots. So, why I would consider selling a call option rather than buying a put option, or rather buying a call option if the market is about to reverse. Okay, so that is where I'm just going to distinguish that and give you a taste of how you should position yourselves, whether to be an option buyer or a seller. Option selling, to be honest, does not really require that large amount of money. Of course, yes, the capital required for an option selling trade is more than an options buying trade. Having said that, you can always hedge and reduce the amount of uh, margin that is required for trading in such ways. Let's go ahead and understand how we can do that. And also at the same point, understanding how India VIX is going to play out in such a scenario. Okay, this specifically is with respect to today's scenario where market is crashing. Okay, so keep that in mind. Do not always consider that is the best way, but considering when the market is crashing, fortunately or unfortunately for us today, the market was on a negative side, extremely on a negative side, except some reversal that happened slightly towards the end. But this is what you can keep in mind and will be helpful whenever such situations arise in the future. Okay, I'm just starting to share the screen and we will be able to see those aspects now. All right. So here, if we can see Bank Nifty again, like I mentioned, yesterday was on a downslide. Today also was on a downslide. I'm like I mentioned in the previous video, yesterday's video, I'm carrying forward some shots on Bank Nifty specifically, index specifically. Having said that, I'm still holding those. I added some more additional shorting opportunities for today. Why I did that, I'll tell you that. When the market is actually falling down, India VIX, that is India Volatility Index, is going to rise up. Since India VIX is going to actually move up higher, inch up higher as the market falls down further because of the fear of uncertainty, because of the fear of downslide, the premiums are also going to go up higher. Having said that, put option premiums definitely will move up higher when the market is falling down. That is what is going to make put option premiums expensive. So if you're considering to buy a put option and market moves in a sideways range or does not crash down further, you're going to lose a lot of amount just because India VIX is crushing. India VIX is normalizing again later. Having said that, I would normally not consider buying a put option in such scenarios, specifically holding a put option positionally for tomorrow's or carrying it forward. If I'm of the view that market is actually going to move up higher, I may consider buying a call option. Normally, people ask me, so what if, sir, if we just go ahead and buy a call option which is out of the money? It is not very expensive. In that scenario, because India VIX is higher right now, those premiums are also expensive. Once India VIX starts falling down, the volatility index starts falling down, the premiums are again going to become much cheaper than they are. Even if market moves up higher, your call option premiums will also drop down. That is one thing that we forget to capture in when we are considering such a trade. What is the third view that you can take? What is the third kind of a trade that you can take? Considering market is already falling down, you can sell a put option and buy a put option for a later point, but you should be aware that the market is now consolidating. Possibly the market may not continue forward to that large extent. That is where you may take this view. But we don't know when a falling market whether it is wise to hold that falling knife and make some profits there. Okay, so having said that, put option you will ideally not want to create those credit spreads. Debit spreads we already talked about uh, is out of question in such situations normally. What if we sell a call option which is out of the money and buy another call option which is slightly out of the money? In a way, we are creating a credit spread for a call option. Okay, so by doing that, uh, in such a way where you're creating those credit spreads, you know at any point in time what is going to be your maximum loss, because the difference between those two strike prices is going to be your loss. I'll give you an example. Currently, market, I mean, if you talk about this scenario, midday scenario, where market was roughly around 40,600, 40,500 levels. If you're considering to sell a call option, you should consider selling it out of the money, where you know with certainty, or you know at least with reasonable certainty, that that amount, that point of strike price is not going to be taken out, because when market reverses back, if it stays out of the money, you are going to earn that premium, that is the credit out of the money will go to zero. Keeping that in mind, you should ideally select such a strike price. It should not go far out of the money also, and it should not be something which is very minutely out of the money. It should be substantially out of the money, but also at the same time, you should be receiving premium. Let us find one such strike price. If I'm talking about a call option, this call options, as you can see, buying a call option in a falling market, the premium is going to drop down drastically. Okay, so this was earlier 1200 rupees or premium for 40,600 call option, which has come down to 500. Okay, so falling market, buying a call option, that is a loss. If let's say I buy a put option, of course it is going to add up huge level of amount in it. It has added 300, 250, 400 points roughly, for which was again far out of the money, which is now slightly out of the money for a put option. Having said that, yes, it is going to add great level of value there, but buying at this point does not make sense. Because if you buy this put option, 379 put option, which is out of the money for a strike price of 40,100, there is a good enough possibility that if market consolidates at this point and goes sideways, you're actually going to lose the money. Okay, so having said that, uh, put option, again, buying a put option in such a scenario is not really worth it. What if we select a strike price which is far out of the money, and there is no possibility or distant possibility? There cannot be a situation which is not possible in a market. Yes, everything is possible in the market. Distantly possible that it may actually become in the money and you may lose money. In that scenario, assuming you consider a strike price which is 1,000 points away, if you consider yesterday's and today's fall, 2,000, roughly 2,500 all points were knocked off from Bank Nifty over the past 2 days. What is the possibility of that happening in the future? If you go ahead and backtest such scenarios where market has been crashing continuously, how many times has that happened? How much of impact of current negative news, based on uh, a report that has been published on one of the premium names in the market? A lot of people would say it was overvalued, all those things. Having said that, that is going to have an impact on the market. That is visible. That is one of the parts which is why we are seeing such a level of sell-off. In such a scenario, if market continues to fall down, selling a call option is going to make you money. Selling a call option is going to be more beneficial, because when the market starts rising up again, also your India VIX, which is going to reflect your volatility, is going to drop down. Currently, it has settled in around 17, 17 and a half levels. But once market starts recovering, this India VIX is again going to come down, normalize to 13, 14 levels. When that India VIX is going to crash, or India VIX is going to be crushed, that is the point where your call options sold are also going to drop down, even if market moves up higher. So that is one of the safest ways in such a market, where market has corrected itself deeply, and even if it goes sideways, that is the fastest way and most reasonable and less risk involved trade in such a scenario. What have I done additionally for today's trade is I have sold far out of the money, 43,000 call option, which I sold at roughly around 40, 41 levels, uh, at two different points in time, roughly around that, averaging around 40, 14 and a half, which currently is definitely at 42 right now. I'm not really worried about this. Unless there is a sharp recovery in Bank Nifty, this is still going to be normalized and it is going to continue here. This had actually gone to 33 levels. 43,000 call option today, which is 27th of Jan, had actually gone down to 33, 34, 32 levels also, what I saw while on the charts. Okay, so having said that, India VIX is going to play that impact, and that is where selling a call option out of the money is one of the safest and easiest way to actually trade in a falling market. One point you may just bring out, sir, what if we sell this call option? I'm going to require roughly around for 25 units. That is one lot of Bank Nifty, roughly around 1 lakh 25 to 1 lakh 35,000 rupees per lot. How how can I reduce that? How can I manage that margin requirement? So what you can simply do is sell a 43,000 call option and buy 43,200 or 43,100 call option. In a way, maximum amount required for one lot each is going to be 25,000 only. You can go to zero the margin calculator, plot in this 43,000 call options sold, and also at the same time 43,200 call option buy. You are going to see the margin requirement is reduced. Of course, this spread 41.95 minus 33.7, roughly 10 rupees, roughly 9 rupees is what you will be earning. But that 9 rupees will again be on a margin which is reduced to 25, 30,000 only. Okay, so that is one way of doing it. I have naked sold 43,000 call option. That is what I'm holding on to right now. Uh, Once it starts becoming profitable, I may add hedge, release some margin from there, and sell further uh, closer if the market continues falling down. Okay, so one advantage of doing this, again, just highlighting, is that even if market recovers, your India VIX is going to drop. Because India VIX is going to drop, that drop is again going to reduce the premiums. For a credit spread, contraction is the best part for you to make money. The quickest and safest way for you to make money is in that scenario. What is my break even in this scenario? 43,040 is my break even, which is strike price plus the premium for this call option. So if market goes up to 43,040 rupees by expiry, which is in 4 days, Saturday, Sunday is gone, Monday, Tuesday, Wednesday, Thursday, 4 days. If it stays below this range, I'm going to make this 40 rupees per unit multiplied by the number of lots multiplied by the quantity in each lot. Okay, so that is one advantage of selling call options instead of put options. If you sell a put option, it is, let's say you sell a put option which is 39,500 put option. Okay, you're going to make higher amount of money. But if the market continues falling down, India VIX is going to rise. That rise in India VIX is also going to affect your premiums of put options, which is going to aggregate to the problem. Okay, so that is why I normally prefer selling call options in a crashing market. That is one interesting way in which you can trade and make money. Okay, I just wanted to bring out this correlation between India VIX and premium prices and what to do in the crashing market. Uh, because a lot of times we are fearful. If market continues to fall down, my put option premiums are going to go up higher. If I sell a call option or if I sell a put option, to that matter, that is going to give me huge losses. But if I sell a call option, there is some advantage of India VIX which is going to work in my favor. That is going to offset to a large extent. Plus, also, I'm selling something which is far out of the money. The possibility of that happening is very distant. Okay. Having said that, the rationale behind selling 43,000 call option for today. If you see today's scenario, okay, I'm just showing you today's scenario. 43,000 call option was one of the most trending OIs also. I happen to see it later. 43,000 call option, if you see towards the end, has taken up a spike which is around this level. I'm just hiding all other strike prices for now. You can see there was a spike towards the end, which signifies people want to take safer positions and sell a call option which is far out of the money instead of something which is very close to the money. If you see 41,000 call option, the open interest has started to drop down. That drop in open interest is indicating that people are not wanting to carry forward that aggressive short position and rather want to shift it slightly towards out of the money. That is where 43,000 call option started to increase in number of OI, which indicates that people are wanting to sell call options but want to be also safer along with it. Okay, so this correlation is something which is very interesting to look at along with India VIX. I hope you loved watching this video and hoping to see you as a subscriber if you have already not subscribed. And thank you for watching it. Stay tuned for further content, something like this in the future, which are minute, integral details about understanding the markets better and being a better trader. Thank you for watching India Trading School official's YouTube channel video and hoping to see you soon. Thanks a lot.